Welcome to How to Retire on Time, a show that answers your questions about all things retirement, including income, taxes, Social Security, healthcare, and more. This show is an extension of the book, How to Retire on Time, which you can grab today on Amazon or by going to www.howtoretireontime.com. My name is Mike Decker. I'm the author of the book, How to Retire on Time, but I'm also a licensed financial advisor, insurance agent, and tax professional, which means when it comes to financial topics, we can pretty much cover it all. Now, that said, please remember this is just a show. Everything you hear should be considered informational, as in not financial advice. If you want personalized financial advice, then request your wealth analysis from my team today by going to www.yourwealthanalysis.com. With me in the studio today is Mr. David Franson. David, thank you for being here.
Yes, glad to be here.
David's going to be reading your questions, and I'm going to do my best to answer them. You can send your questions in right now to 913-363-1234. Once again, that's 913-363-1234, or email them to heymike@howtoretireontime.com. Let's begin.
Hey, Mike, why do people put money in bonds and bond funds when equities do so well?
It's a great question, especially when you have, and this is not meant to be demeaning, but short-term memory. So the purpose of bond funds, let's be very definitional for a moment.
Helpful, yes.
Bond funds are not supposed to beat equities. They probably will never really beat equities over a long-term period of time. The purpose of bond funds, we're talking about bond funds, like ETFs or mutual funds that trade bonds.
Okay.
We're not talking about bonds themselves.
Individual bonds.
That's a very important distinction.
Okay.
Bond funds are there to help protect you, and not literally protect you, but help lower your risk, downside risk. Okay.
Sure.
The problem is a lot of people have assumed that bonds and stocks are negatively correlated, or as in if stocks go up, bonds go down, and if stocks go down, bonds go up. There's actually not a negative correlation.
Okay.
So let's break this down even further. So the theory behind it, and this was done by Harry Markowitz, who got a Nobel Prize for this, basically said, hey, put 40% of your assets in bond funds. Maybe they'll average around 4 or 5% year over year, and 60% of your assets in stocks or equities because they have more growth potential and you want the growth potential. But in the years that the markets would go down, typically when markets go down, they would drop interest rates. If you drop interest rates, then bond funds go up. Does that make sense? This is not a normal thing. That if interest rates go down, bond funds make more money.
Yeah, I don't know. Why is that? Do we know?
There's a direct correlation with it. So think of it this way. This is my chicken analogy.
Right.
I like chickens. I like eggs. So here you go.
Yeah.
If you have a chicken that you're selling for $1,000 that's guaranteed to live for 10 years, and it's going to give you 3 eggs every week for 10 years. Okay, you know exactly what you're getting, right?
Yeah.
All right. Now imagine that science has a breakthrough and you can now buy a chicken for $1,000.
Okay.
Same price, but you're going to get 5 eggs every day or every week for 10 years.
Okay.
Do you want to pay $1,000 for a chicken that gives you 3 eggs?
I want to maximize my return here. I want the 5.
You want the 5 eggs.
Yeah.
It's the same thing with the Fed's new rates. So if the Fed is currently offering 3 eggs or 3% and increases to 5, then your chicken that's offering 3 eggs, you have to discount it, maybe sell it for, $600 or something like that to offset what you would have missed by the extra eggs had you just paid the normal price for the 5-egg chicken. Now let's do the inverse. So if you're buying, let's say, chickens that give you 5 eggs, it's kind of a funny analogy, right? But you buy a chicken that's guaranteed to give you 5 eggs for 10 years, 5 eggs a week for 10 years. And now those chickens don't exist anymore. They're all offering 3 eggs a week. The chicken that's offering 5 eggs for the rest of its 10-year life, they're more valuable.
All right.
So they would increase in value.
Okay.
This is how basically bonds work. Now, not bond funds, but bonds.
Yeah.
So the value of your bond is compared to the current interest rates or the current offerings. Basically, is it a chicken giving you a lot of eggs or less eggs compared to what's been out there? You see the difference there?
Yep.
So if the Fed increases rates, that means the new products, the new bonds, are of better value. And so everything else that's historical loses value because it's not worth as much. It's less competitive. And then the inverse. If the Fed drops rates, then whatever has happened, it's more valuable until it matures and then it's gone. So bond funds are actively trading bonds.
Oh, right.
So if you're a trader, if you're a bond trader, okay, and the bonds you have are now more valuable than the new bonds, that helps increase your overall value of the bonds, the bond fund that you manage. Are you following me with so far with this?
Yeah, absolutely.
People really struggle, and this is the simplest version of it. It gets much more technical, but the idea is if you have a bond fund, okay, and the markets crash, so the equities have gone down, okay, the Fed is going to try and rescue the market by making money cheap. The way the Fed makes money cheap or cheap to borrow against to try and bail ourselves out or to recoup from things is they drop interest rates. So it's cheaper to borrow money. If you drop interest rates, then bonds increase in value. So if bonds increase in value during a market crash, that increase can help offset some of your losses.
Okay.
That's kind of, in a very simple summary, what Harry Markowitz was trying to explain, which won him a Nobel Prize. But people have assumed that this will always happen. So in 2022, 2023, bond funds and equities or stock funds both lost money. And if you look at the last 120 years or so, there are many times where both bonds and stocks, I should say funds, so equities funds or stock funds and bond funds lost money together. And it can happen. The idea is to diversify with uncorrelated asset classes, and the stock market is uncorrelated with the bond market. So because they're not correlated, it's a way to diversify. And the reality is there's plenty of markets. There's really 6 markets if I'm to categorize it. You've got cash and cash equivalents, so your high yield savings and money markets. You've got the bond market, which is the largest market. You have the equities market or the stock market. You have the insurance product market. You've got the real estate market, whether you actually have real estate or not. You've got REITs. You've got Delaware Statutory Trust. There's other ways to invest in real estate. And then you have the alternative market, which is its own thing unto itself. For most people, though, they're not going into real estate. They're not going into alternatives. They're really trying to build a growth-focused portfolio, but not take too much risk or not have enough risk because growth is equivalent to the risk you're taking. So the more risk you take, the more growth potential you have. That's why the bonds are in here. It's to help lower your risk overall. But if you add bond funds to your portfolio, you have less growth potential.
Okay.
You can't have it both ways.
Yeah.
So when people say, well, hey, I've got the Magnificent Seven, you've got NVIDIA, Microsoft, Apple, Google, Tesla. That's a very concentrated portfolio.
It is.
They're all going up, but what if they go down?
Yeah, and that could happen, right?
Yeah, so how much risk are you willing to take? And that's a pretty misunderstood concept of what risk is. Maybe we'll talk about it another time. But do you see this idea of, okay, people put bond funds not to make money. Bond funds aren't going to make you rich. They're there to help stabilize you and hedge against equities risk.
Yeah, that makes sense.
So here's just a couple of examples. Let's say you're a Magnificent Seven investor and you believe you're really smart because you bought the Magnificent Seven. Oh, yeah. You've had a great couple of years.
Yeah.
But if you had followed that same philosophy, let's say in 2000, the dot-com crash, you had Amazon was great, Google was a thing. Was Google a thing?
That was sort of mid-2000s.
That was mid-2000s.
Yeah. 04, 05, 06.
Let's see. IBM was a big thing. I mean, the dot-com boom, right?
Mm-hmm.
So Microsoft was a thing there.
Oh, yeah.
So in 2000, these equities just tanked. And if you look at the NASDAQ, I think it was down like 70% or something like that. I mean, it was harsh, but where there's more growth potential, there's more downside risk. We just forget that can happen. And if you look at Amazon, go on Google, or what's the other ones that are out there? Yahoo, Bing. I shouldn't be preferential to Google.
Yeah, right.
Go online and look at what Amazon did. For example, love Amazon. Great company, great, price, great stock. I'm not saying you should buy Amazon. I'm just saying it's done well. But go on there and watch how much it grew until 2000 and how it tanked and didn't recover for 10 years. What if your Magnificent Seven starts to maybe go down and doesn't really grow for 10 years? That is a risk that you're taking. Whether you realize it or not, no one knows the future. So am I saying you should sell Magnificent Seven? I'm not saying that. Am I saying you should sell NVIDIA because it can't go higher? I'm not saying that. What I'm saying is put all your eggs in one basket may be an oversimplification that takes more risk than you may realize. Because when it gets to retirement, it's not about how do you get rich and become the richest person in the graveyard. It's about staying rich. So a 20 and 30-year-old, yeah, you could risk it. You could concentrate and try and take on that additional risk for more growth potential. But when you're getting close to retirement, you might be right. But are you okay with the possibility of being wrong and the consequences that would ensue? People say this word, I'm diversified, but I don't think they really understand what it means. So you don't diversify your assets to grow. Think of it this way. If you invest in a lot of different positions, there's a good chance that there's a lot of mediocre companies in there who maybe aren't growing, but maybe they don't crash as much either. They're just kind of steady Eddie, boring. Some people like that. Some people are okay with the wild ride. If you want a wild ride, you're not diversifying from a broad perspective. You're hand selecting different positions, and it could do great. It could go down, and it could go down hard. We need to stop. This is such a difficult thing for the human condition, but stop falling for our personal bias of saying, well, this is how I think it should be because this is how you need it to be. Do you really need that growth? And what happens if it doesn't go like as planned? It's FOMO.
Okay.
Fear of missing out.
Mm-hmm.
People hate bond funds when the markets are on a tear going up. People love bond funds when the markets go down and interest rates go down because they help offset it. I think the whole thing's just kind of funny because I personally think in retirement, instead of bond funds averaging 4 or 5% around there, why wouldn't you just ladder out a bunch of CDs, treasuries, and fixed indexed annuities? If you do it right, they could have similar growth potential, but they can't go backwards. I think there's a more comprehensive or a more complete way to put together a portfolio that doesn't just rely on broad diversification in equities or stocks and bonds or bond funds specifically. I just think it's an oversimplified approach saying, well, this is the silver lining. We found the perfect balance for you.
Right.
On the ups and downs that you're going to experience. I just have a hard time kind of swallowing that. Did I explain that okay? I mean, is this making sense?
It does. It does make sense. We have this sort of the common wisdom that's been around for, I don't know, whatever, decades, right? Stocks, bonds. A stock and a bond, just kind of, you got to have this much of that and that much of this.
I'm not quoting prices here. Okay. I'm not saying this is how it is. But what if, just for example, you could find assets, products, investments that were protected, couldn't go backwards, but still had the same average growth moving forward? Why wouldn't you expand your investment horizon into other markets that maybe have some protection? Maybe they don't have protection, they've got more growth potential, but expand instead of just opting into a basic stock bond fund portfolio. There's so much more out there, but it's the cliche. It's what we're familiar with. It's what we're comfortable with. And I think that's why people oversimplify their strategy and end up relying on what I would call an incomplete retirement plan with an incomplete portfolio that does not hedge, again, in my opinion, appropriately against the flat market cycle or the market crash or the inflationary risk or, fill in the blank. There are so many risks to go on there. So going back to the question, why do people put bonds or bond funds in their portfolio when equities do well? It's because, and this is kind of the expression in the industry, it doesn't matter until it matters. Your bond funds are not really there for when equities are growing. They're there for when they don't. And no one can time the market. That's all the time we've got for the show today. If you enjoyed the show, consider subscribing to it wherever you get your podcasts. Just search for How to Retire on Time. Discover if your portfolio is built to weather flat market cycles or if you're missing tax minimization opportunities that you may not even know exist. Explore strategies that may be able to help you lower your overall risk while potentially increasing your overall growth and lifestyle flexibility. This is not your ordinary financial analysis. Learn more about Your Wealth Analysis and what it could do for you regardless of your age, asset, or target retirement date. Go to www.yourwealthanalysis.com today to learn more and get started.